In my experience, entrepreneurs tend to be very optimistic about their businesses, which makes sense. Who'd want to invest in a company that the investor believe in? That places me in a very important role, which is to set realistic expectations on behalf of the entrepreneur that is seeking capital. Yes, on the one hand, I could, of course, make an entrepreneur happy by telling them that their startup that's going to turn peanut butter into jet fuel, but hasn't even patented an invention yet, is worth $100 million. But that doesn't help them if they go out to the market and every investor just dismisses the valuation as unachievable and therefore they never raise capital. One of my roles, and a very important role as an independent expert, is to tell the client what they need to hear. And one of the most important things that you need to hear as an entrepreneur is what would be a realistic range of market valuation expectations. And maybe you're disappointed in what that value range may be, but you can address it by potentially delaying raising capital until your company's story is a little bit stronger, or you might be able to achieve some concessions in the terms of the investment so that your overall return on a risk adjusted basis is maintained, even if the headline number valuation is lower than you would like. A common mistake that entrepreneurs make when raising capital is they focus too much on price and not enough on terms. Price and terms are dancing partners, and you can achieve almost any price you want if you're willing to accept highly punitive terms. You might get that $100 million pre-money valuation for your company if you're willing to accept full ratchet anti-dilution terms, which means that if and when the next round comes in at a lower valuation, you're basically diluted down to whatever your share would have been had you agreed to a more reasonable valuation. As important as valuation is, it's important to recognize that it's not the only thing to focus on. There can be some very good reasons as to why you may want to accept a more modest valuation in exchange for capital. The most obvious reason is you just need the money. If you don't raise capital, you're not going to be able to make payroll in a few weeks, and your business is not going to survive. And then your valuation's not going to matter. So sometimes you just have to accept the fact that you didn't meet quite the right investor or investor group. You got to take the money, and then hopefully you can grow out of the deal that you don't love on the front end. That just happens sometimes. A second consideration is what else the investor or investors bring to the table. Some investors want to be purely passive in nature. They want to sign a check. They want you to tell them how great the company is doing every once in a while, and then come back to them when you're ready to sell and give them their return. And if that's the kind of investor you want, that's fine. And you may achieve a higher valuation by raising capital from such investors. However, other investors can bring a lot of value beyond the check that they write. They can provide coaching and strategic guidance. They can provide access to follow-on capital and investors. They can provide operational expertise because perhaps they have experience in the business or the industry that you're operating in. They may be able to introduce you to potential customers, in which case it may be worthwhile to offer a little bit of a discount to such investors because the very involvement of the investor is going to add more value to the company over time, and you're going to make that valuation up in following rounds. And then finally, it's important to consider the terms of the investment. When you receive an offer to invest in your company, there's a reason it's called a term sheet and not a valuation sheet. Valuation is just one of the line items in the term sheet, but the term sheet is going to present you with numerous other conditions for investment, such as board seats, such as being able to veto certain consequential decisions of the founder, or being able to set your salary, or agreeing to borrow money, or raising money, or being involved in the sale of the company. Protection rights such as anti-dilution, and the nature of the shares themselves, whether they're common shares or preferred shares. Those terms can have a profound impact, as profound an impact, if not more, than the ultimate valuation on how happy you're going to be with the outcome of the actual investment. So make sure that while paying close attention to price or valuation of your company, that you're not overlooking the terms, because the terms can be quite intricate, they can be complex, and they can have as much an impact on your future financial outcome from the company as the valuation itself. What some valuation experts can do, and I happen to be one of them, is we can help you understand the value impact of these things that I just talked about. What is the value impact of an investor that can add to your management and make your management team more robust, and therefore make your company more credible to potential customers and potential follow-on sources of financing? Or what is the value impact of an investor that's able to bring you customers and open doors for you that you may not have been able to open by yourself? Or what is the value impact to you of selling preferred shares or convertible debt as opposed to purely common shares? What is the value impact to you of accepting partial ratchet or full ratchet anti-dilution concessions as opposed to no anti-dilution? If you're going to accept those kinds of conditions, what should your counter negotiating position be in terms of asking for a concession on valuation at that point? That's something where we can help you make sure that you're in a position to make the best deal that you possibly can. Everybody looks at Shark Tank as sort of an example of venture capital deals. And I'll share with you a little secret. Even though I've worked with two founders that have been offered funding on Shark Tank, neither of those founders actually accepted the funding. And Shark Tank is basically the WWE of venture capital. There's a lot that goes on. It's not just the 10 minutes that you see on television behind the scenes. And you probably know that because we're all grown-ups and we know that television isn't real. In Shark Tank, the investors will say, we want 25% of your company for $300,000, okay, which implies a $1.2 million post-money valuation. 25% of $1.2 million is $300,000. But they don't talk at all about the terms. And so the reason I say that I've worked with two companies that have been offered funding on Shark Tank is because they ultimately turned down the funding because the terms came in that were, in their minds, so punitive that they chose to walk away from the deals entirely. That's a real world example of how terms are a critical and potentially deal making or breaking facet of a capital raising transaction. For example, in one of the companies, the term was that the shark who decided to offer an investment wanted full protection of anti-dilution, meaning that if the company lost value in the next round, that the founder would take the entire financial hit. They also wanted 3 out of 5 board seats, which gave the investor de facto control, even though that they were receiving only about 25% of the company. The investor was going to gain control of the company pretty much overnight. The founder was not interested in ceding control of the company. I think they could have lived with the anti-dilution provision because they were very confident they were going to grow. And in fact, they did. They wound up selling for a very healthy exit only 2 years after turning down that funding. So I wonder if that shark has any regrets about that. But they didn't want to give up control. And maybe with the shark involved, they would have achieved an even higher valuation in an exit. But as it turned out, the founders became multimillionaires, and I'm sure they have no regrets over how things played out. So whether you're raising money from friends and family, whether you're raising money from professional investors, whether you're raising it for the first time or it's your second or third capital raise for the same company, or whether you're even contemplating appearing on Shark Tank, I can be your dance instructor and help you understand what to expect. Make sure that you're setting expectations for yourself that are realistic in the market, and help you negotiate your transaction and help you negotiate your capital raises from a position of informed strength. Thanks for watching this installment of Your Business Value. And if you received value from this video, please subscribe and let me know in the comments what topics you would like me to cover next.